If you're a veteran and you've been told your VA loan is one and done and that sellers won't accept a VA offer or that the funding fee is just PMI in disguise, every single one of those is costing you money in 2026. So I'm going to give you 5 myths in 6 minutes. And the third one is one I wish every veteran and active duty person knew before they started even looking at houses. So myth 1, sellers won't accept a VA offer. And this one, it comes from a real place because years ago, the VA offer had a reputation for being complicated, and some of that thinking is still around today, but the market has definitely changed. In 2026, VA offers are absolutely competitive. The appraisal is going to be checking for basic safety and habitability. It's not checking for cosmetic perfection. Closing timelines, they're definitely in line with conventional, and we're going to get to that. And one thing a lot of people don't realize is that sellers are not required to pay a VA buyer's closing costs. And seller concessions on a VA loan are negotiated basically just like any other offer that comes to the seller. But when a VA offer is presented well, like a clean contract, strong pre-approval, realistic terms, it stands right alongside any other offer that is presented. So myth number 2. You only get to use your VA loan once. This one doesn't make sense. And this one is really one that shuts people down before they even start. Say they used it years ago, they moved, and they assume they're locked out forever. And that's just not how it works. So your VA loan benefit, it can be used over and over. And there's no limit on how many times you're able to use it. What does change, though, is something is called entitlement. That definitely can change. So say you paid off a previous VA loan, you sold the property, your full entitlement is going to be restored. So basically you're back to first time user status. Your VA funding fee, it does change. But if you still have an active VA loan, like say you're holding onto a previous property as a rental and you're financing a new primary residence, you may be able to use your remaining entitlement on that next purchase, sometimes still with 0 down, and it's really just going to depend on the price and your county's conforming loan limit. Because in 2026, veterans with full entitlement have no loan limit whatsoever. And here's the piece really worth understanding. You can have 2 VA loans open at the same time. For active duty personnel on PCS orders, this opens up a strategy where you hold the previous property as a rental and you use the remaining entitlement to finance the next one. Over a career, that can really compound into a ginormous portfolio, to be honest. So if you've ever been told your VA loan is one and done, you've got more available than you actually might realize. So myth number 3, VA loans take forever to close. This one used to be true because years ago, the VA process was more paperwork heavy and that reputation, it really stuck around. Where we are now though, the national average for a VA loan purchase is 40 to 50 days, basically the same as a conventional loan. And when the file is clean and everyone's moving quickly, most of our closings, they come under 30 days. So it's pretty quick. Basically, the VA program itself isn't slow. It definitely rewards preparation, a complete document packet up front, property in good shape, and a team that communicates well. If you line those up, and the VA loan can be as fast as anything else on the market. So myth number 4. VA loans require PMI or private mortgage insurance. They definitely don't. Not now, not ever, not any loan amount, not with 0 down, no PMI, full stop. On a conventional loan with less than 20% down, PMI runs roughly 0.5% to 1% of the loan amount every year. So on a $400,000 loan, that's $2,000 to $4,000 a year, and it can take more than a decade before you're done paying it. And the good thing is VA loans, it skips that entirely. What VA does have is something different. It's a one-time funding fee. And that's where the confusion comes from, which is myth number 5. So myth 5, the funding fee is basically PMI, private mortgage insurance, with a different name. It's not. And once you see the math, you're going to understand why it just doesn't work that way. So the funding fee is a one-time payment, and it keeps the VA loan program running. It's how the VA can offer 0 down and no PMI in the first place. So here's the 2026 breakdown. First time use, 0 down, 2.15% of the loan amount. Subsequent use, 0 down, 3.3. Put 5% down, it drops to 1.5 for both. Put 10% down, 1.25. So the three things almost nobody tells you. One, if you have a service-connected disability rating of 10% or higher, you're completely exempt from the VA funding fee. Certain surviving spouses and active duty Purple Heart recipients, they are also exempt, not reduced, completely waived. Two, you can roll the fee into your loan. No cash is required at closing. Three, and this is brand new for 2026, the funding fee is now tax deductible if you itemize on your federal return. That benefit did not exist last year. So bring it up with your CPA when taxes are coming up. So one-time fee versus ongoing monthly PMI for most borrowers, VA comes out way ahead over the life of the loan. And here's where I'm going to leave you guys. In my honest opinion, the VA loan is the strongest home loan program in the country. You've got zero down, no PMI, flexible credit guidelines, funding fee exemptions for disabled veterans, and now a tax deduction on top of it. So if you're thinking about buying in the next year, or even just wondering what your benefit can do, the link in the description will get you to our team. There's no pressure, no pitch. We'll look at your situation and tell you what's actually possible. Subscribe so you don't miss the next one, because we've got more breakdowns coming and you're going to want to watch it. So drop a comment. Which of these myths really had you convinced? And I'll read every single one and respond to you. So I'll see you on the next one.